Hello dear traders. Wall Street closed not only the week but the whole quarter in the green. It showed a considerable rise on the last trading day of the month. Thus, on Friday, the Dow Jones Industrial Average surged by more than 400 points, while the S&P and the Nasdaq added 1.4 and 1.7% respectively. The U.S. Consumer Spending Index, which is a good inflation indicator, turned out to be lower than expected at the level of 4.6%. Investors saw a clear signal that inflation had reached its peak. This in turn boosted speculations about a possible end of the upward cycle in the key rate. Meanwhile, the Fed remains stuck to its approach that contradicts investors' view on the situation. Some politicians suppose that to cap inflation, it is necessary to continue monetary policy tightening despite the recent turmoil in the banking sector. That is why traders will search for the confirmation of their assumptions in fresh reports. This week is expected to be very rich in important macroeconomic reports. However, the main attention will be paid to the ADP non-farm unemployment change figures, as well as services and manufacturing PMI data. Watch the video up to the end and leave a comment. Sentiment in the U.S. stock market is still shaped by three factors, including economic growth, inflation, and the banking crisis. There was a moment when the banking system collapse achieved dominance, thus reducing the appetite for risk assets. However, the authorities' immediate reaction managed to elevate concerns over a global crisis similar to the one in 2008. It was decided to provide affected financial institutions with liquidity support. Shares of technological firms showed a great performance and acted as a safe haven for traders amid mounting economic uncertainty. Nevertheless, the problem in the banking sector has not been settled yet. Traders are estimating future actions of the Fed through the prism of this issue. Recently, former New York Fed President William Dudley pinpointed that the banking crisis will play a key role in the next Fed's key rate change. However, inflation remains the main factor that is shaping the regulators' decisions. Early this week, investors will continue to estimate future changes in inflation and the rise in the benchmark rate. On Monday, futures on the U.S. stocks showed a mixed dynamic with an insignificant drop. This reflects traders' uncertainty ahead of the publication of important macroeconomic reports. Thus, futures on the Nasdaq and the S&P slid by 0.4 and 0.2% respectively, while futures on the Dow Jones increased. A risk of a recession is still in force, but now it is expected to occur a bit later. At the moment, there are a lot of factors that are pointing to the economic recovery. In the first quarter, the US GDP may increase by 3.2%. Meanwhile, a recession may take place in the next 12-18 months. In the short term, investors will continue relying on figures. At present, they are quite positive, which is proved by the stock market trend. In the first quarter, the Dow Jones Industrial Average increased by 0.4%. This is the most insignificant change in the key indices. The largest growth was displayed by the Nasdaq. It manifested the best quarterly performance in the last 3 years. We will return to the issue a bit later. Just after traders learn important macroeconomic data of this week, they will focus on numerous reports that will be issued from the mid of April. Analysts suppose that the situation with inflation will become worse. Concerns about mounting inflation pressure and further monetary policy tightening increased just after OPEC Plus unexpectedly announced a cut of the oil output. Under the current conditions, the likelihood of the 25 basis point rise surged to 65%. Earlier, such a possibility was estimated at 55%. As for the labor market, the anticipated data may unveil a decline. There is no wonder, as in the end of the autumn, several large IT companies announced massive staff cuts. Later, reports of new layoffs in various sectors of the economy began to snowball. Now it is second round of cuts in IT companies. In addition to layoffs, such firms are also closing previously open vacancies. For some time, such layoffs were not affecting the unemployment indicator. Some of the slashed positions were returned thanks to remote work and foreign branches of companies. After a significant improvement in the epidemiological situation, demand for labor has sharply increased, especially in the manufacturing and construction sector. At the moment, demand for the labor force is still high in these sectors, which is offsetting the overall number of cuts. However, the situation may change. Last month, the U.S. unemployment rate jumped by 0.2%. Although in March this indicator will hardly change, all other indicators of the labor market may decrease. The U.S. economy is expected to add 283,000 jobs, this time below the 311,000 jobs recorded in the previous month. The ISM manufacturing and services PMIs are also projected to go down. Anyway, all figures should be within the Fed's range. Of course, the actual results might be slightly different from forecasts. The next FOMC meeting is scheduled for May 3. More data reflecting the state of the U.S. economy and the jobs market will come by that time. If NFPs keep declining, the Fed may decide not to hike rates anymore. Meanwhile, the S&P gained 7.4% in the first quarter. All three main U.S. stock indices are now in a horizontal trend due to the statement from OPEC+. Nevertheless, they are seen to be in a bull trend shortly. In the second quarter, there will be enough positive factors as well as risks that will drive quotes. Currently, we can see a reversal in the S&P in the medium term. The index is consolidating before skyrocketing. The end of the Fed's tightening cycle will be the main driving force for the S&P. If quotes settle above the mark of 4,120, investors are likely to push the price to the level of 4,300, with intermediate targets seen at 4,195 and 4,270. Volatility will probably stay moderate. The fact that the indicator has gained over 7% since the beginning of the year may be the start of a bigger trend. Analysts assume the S&P will swell 15% and hit the mark of 4,600 by the end of the year. There will be several factors behind this growth. The banking crisis will be under the control of the Fed and the Federal Deposit Insurance Corporation. In fact, banking woes may urge the regulator to stop hiking rates, thus boosting the stock market. However, due to high inflation, possible scenarios are hard to predict. Still, one thing is clear: the Fed's action will be different this time from those during the crisis in 2008 and 2020. Back then, the bank used all tools to stimulate the economy, including interest rate cuts. This time, the Fed's main goal is to bring inflation to the target level. The bank intentionally does nothing to avoid a recession, which means interest rate cuts are unlikely this time. The Nasdaq 100 gained 17.6% in the first quarter and showed the best three-month performance since 2020. On the daily chart, there is a double bottom pattern with the key level at 11,920. The price closed above 12,000. The index is now heading toward the mark of 12,800. In fact, this level is seen as a high from which the index may reverse and go down. The Nasdaq comprises about 50% of tech stocks and about 30% of secondary needs and healthcare stocks. Since the beginning of the year, the IT sector has gained 18.4%. Communication service providers have added 17.4%, and the healthcare sector has lost 4.3%. Among the best performing companies were Nvidia, plus 84.6%, Apple 23.7%, Microsoft plus 17%, and Oracle plus 10.9%. In the second quarter, investors are likely to bet on companies with growth potential, that is, undervalued firms with interesting business ideas and attractive dividend yields. All in all, companies such as Applied Materials, Cisco, IBM, and Qualcomm will draw investors' attention. By the way, Tesla's shares were down by over 5% at the beginning of the second quarter. Price cuts could not bring the desired result. Business growth is slowing down. At the same time, Elon Musk said Tesla could achieve 2 million vehicle deliveries this year, up 52% from last year. According to Chinese electric car manufacturer NIO, Tesla has little influence over EV prices in China. The fall in prices is the result of strong competition in the market. This has been our overview of the stock market. Stay tuned and don't forget to subscribe. See you in our next video. Bye.